My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make your own money. My job is not just to entertain, but to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Sometimes you get used to certain stocks being winners for so long that you aren't even aware when their triumphant status possibly runs its course. And that's how I am feeling right now about still one more day here with tech wilting on the vine. Dow losing 155 points, S&P slipping 0.33%, NASDAQ declining 0.53%. Like most market participants, I am unwilling to say goodbye to tech. It's been such a long-term winner that I'm reluctant to forsake it. And please, look, I just did come back from NVIDIA's GTC conference last week. Things were going great. I can't just say, well, that's over 8 days later. But when I scroll through the winning sectors for the year, I am struck by how they represent a wide array of groupings that aren't tethered to any particular economic worldview. Neither a recession viewpoint nor a severe slowdown can explain which groups are pulling away from tech and communication services, the sub-rubric that includes many internet companies. The leaders for the year, indeed, are very strange, counterintuitive, or you can just call them broad if you wanted to. Let's start with the number one performing group, and this is a true oddity. Let's talk about the energy sector. Now, we know the president's deeply committed to lowering the price of oil in this country, something that was actually referred to by Vice President Vance in that bizarre signal thread that accidentally included Jeffrey Goldberg, a harsh Trump critic, and the editor of The Atlantic. The exchange, which has proven to be true, has Vance wanting everyone on the chain to know that it would be most unfortunate if an attack on Yemen causes the price of oil to jump. Yet here it is. Number one, top of the heap. And I want to be a little subject here and dip to the third best performer in the oil and gas space because the top two really aren't that representative enough. And the third is Chevron, long my favorite, which is up 15% to start this year after some really kind of longer period of underperformance. And some of that success is because of the company's hefty dividend that yields north of 4%. Underneath Chevron on the list are a host of natural gas companies, which were big winners in the liquefied natural gas LNG export market. I think the group's also being helped by strong demand for natural gas power from the nation's myriad data centers. That could only just get better. Now, I thought this group would be down, given that the president wants to expand drilling and we have a slower economy. But the stocks aren't expensive, and demand for natural gas, very strong. Coming in second is healthcare, and I think that's representative of the view that tariffs and prospective tariffs might cause a recession. And by the way, healthcare's got much more away from drugs. Service can't get tariffed. These are textbook slowdown stocks, though. There's a nice trio at work at the top of the healthcare sector. First is CVS. Now, it's long a laggard and has come back with new management, as well as a resurgent Aetna health insurance business. Vertex Pharma comes in second. I don't give you that enough because they got this terrific new opioid non-habit-forming painkiller. And then third, there's Cencora, a classic drug middleman, part of a subgroup that always seemed to send someone out at the top. To prove that the theme isn't just recession, financials are the third best performing sector. And we know this group has a hefty reliance on credit, which sours in a recession. Insurance has been incredibly hot this year with a remarkable pricing factor. As you know, you know all too well if you own the stocks of Brown & Brown or Arthur J. Gallagher, two storied insurance brokers that top the list of best performers in the group. I've never met anybody who owned them, though. The third finance name, Intercontinental Exchange, ICE, owns the New York Stock Exchange, as well as a host of commodity exchanges. I really like that stock. None of these have any real credit risks. That's one of the reasons why I like them. But they're financials nonetheless, and the bank stocks are acting much better than expected, even if they're not at the top of the heap. Now, the consumer staples, long considered safety stocks, well, let's just say they aren't all that safe these days because of a host of challenges, everything from GLP-1 drugs weighing down the food business to higher prices for all sorts of commodity inputs. But there's a frequent winner here among the consumer staples. It's one I won't recommend because it's got tobacco in it, and that's Philip Morris, the international tobacco company. It's one of the greatest stocks of all time, though. Walgreens has made a comeback, too, but it's going private. Consider that one done. Do not want to own that. Do not want to buy it, whatever. Dollar General is number 3, and it's stock that historically has done well in a slowdown. Two food and beverage companies managed to make the cut, triumphing over the GLP-1 anti-craving drugs, perennial favorite Coca-Cola and Mondelez. Nice broad grouping there. From the recession-resistant to the recession-suspect, we go to materials. On top is Newmont Mining, because gold's had an amazing run. Is that fear? Now, I don't know. I mean, as a matter of fact, tariff worries, maybe? Precious metal being a good storehold of value? Hey, you know what? Maybe giving out gold's astronomical outperformance, a bit of all three. Steel Dynamics comes in second within the materials group, and I think that's a winner in the tariff wars. Third is fertilizer company Mosaic. Now, it says something when the most complex tech instruments ever are all out of style this year, while people bet on the most simple formulas, the most commodity of commodities. Can't think of anything less glamorous or easier to make than fertilizer. When interest rates go down, we normally look for utilities, but rates are going higher here. Now, it could heretofore mean that people want to profit from a slowdown, if not a recession, by buying companies with consistent earnings. So if they're buying Consolidated Edison, which is Con Ed, a purveyor of electricity for the New York metro area, as well as number 2, Exelon, the name of the utility that encompasses Baltimore Gas and Electric, PECO, that is the old Philly Elect, and ComEd, that's the old Commonwealth Ed, Chicago utility, well, what can I say? It's plain as it gets. The REITs rule in real estate. That's the 7th best performing group, the real estate group, and we have 3 very different ones showing the broad nature of this rally in this part, this subset. First is Welltower, that's a healthcare infrastructure company. And then American Tower, which is the REIT that owns cell towers. Then there's Ventas, a REIT dedicated to senior living. We used to have them on all the time. Talk about broadening of the market. I mean, call this a paragon of diversity here. Finally, there are the industrials, again, a group that's prone to failure during a recession. See my point? These are all oddities, right? The industrials are led by Uber Technologies, which is a much more of a services company that's somehow classified in the group. Then it's followed by GE Aerospace and Howmet, which makes fasteners for planes. These are both part of the aerospace bull market, which is still going on. It's a quiet one that shows no sign of quitting at all. More on that one later. These new winning sectors haven't seen the light at the top of many, many quarters because, well, I mean, for ages, it's been tech. For years, people have talked about how they would hope that the rally could finally broaden out beyond tech. And now that's exactly what's happening. Except you can't call it a rally anymore. Now that the broadening has arrived, investors seem to pine for the stocks of yore, mainly the Magnificent Seven, which are split between the communication services sector and the information technology sector, but they share one thing in common. They're almost all bad. We can't be too duplicitous here. A day like today signals a healthy market, even in the face of what we're endlessly told is a troubled market. Intriguing, right? Ironic, maybe? I don't know. Now, none dare call this a bull market. The 7 stocks that make up the once Magnificent Seven are too big to dismiss. You need at least some of them to put together a really positive tape. But the bottom line, it's terrific to see such a broad mixture of stocks winning here, from ones that can run in a recession to ones that can rally hard in a robust economy. What it tells me is that the market may be far healthier than we think, and this backdrop simply isn't as bad as many would have you believe. Let's go to Frank in New York, please. Frank.
Hello, Mr. Cramer. How are you today?
I'm good, Frank. How you been?
Pretty good. It's baseball season, so it's all looking good.
Yeah, I know. We got a game right now with the Phillies. But I'm working, so I can't really go watch it because no one's going to pay me to watch it. Will anyone pay me to watch a game rather than do my show? Probably not.
Well, your staff is always there. They're great, you know?
Yes, it's true.
So anyway, looking at Flutter, what do you think of this one? FanDuel?
I like Flutter. I like FanDuel. I like Flutter. This group is sold off. I think it's sold off too great. And I think Flutter's a terrific company. Actually, I think it's a really, really good company. But I like your. I said I like both of them. I'm sticking by that. Let's go to Alex in my home state of New Jersey. Alex.
Hey, Jim. First things first, I got to thank you for everything you do for us and for keeping such a fun and lighthearted attitude at all times, no matter what's going on.
Well, thank you. I got to tell you, I'm going back and forth with Jeff Marks. It's a hard day for us. You know, we own what I would say for the club, too much tech. But it's been so right for so long. I have to acknowledge that it's been wrong for 6 days, but I can't give up the ship. Thank you for those kind words. How can I help you?
So this company that I'm wondering about, I mean, them like everyone else, the uncertain times, they are very, how can I say, at privy, and they could be in trouble. And that stock is FedEx.
Yeah. Now, you know, I'm going to be careful in this because I was one of the few people who thought that quarter had something that I really like to see. The revenues went down, okay? Yet the earnings went up. The revenues were missed, but the earnings went up. That means if they start getting more sales, that thing could explode higher. I actually am not against holding position in FDX. Why don't we go to Stackwell in Washington? Stackwell.
Biggity, booyah, Jim. What's going on, Jimmy Chill?
I don't know. You tell me, Stackwell. I'm chilling here. I'll tell you that much. I was like shaking cold earlier. What's happening?
Man, the market's looking real shaky, man. You know,
there is an element to that, absolutely.
When it gets kind of sick, man, we need someone with a PhD out here, man. You know, and I know that they got a lot of PhD player hater degrees after you, man. So I'm gonna give it to you real, man. When it's looking turbulent, like we need something more grounded, man. Tell me how you feeling about FCX, man. Freeport McMoran.
All right, I think copper's going higher, and one of the reasons why I like it, by the way, is China's coming back. They're the biggest user of copper, but also something that Jensen Huang told me from NVIDIA. He said, listen, copper is just the right thing to have in the data center. I was hoping to be replaced by glass. Doesn't happen anytime soon. 2/3 of the copper is used by China, and China's making a comeback here, or at least parts of China are making a comeback, and thank you for the kind words. I like that. Jimmy Chill is back. Frank in Texas. Frank.
San Antonio, booyah to you, Jim.
Oh, man, what a town. What a town. I love that town. How can I help you?
Well, I have a small position in Wells Fargo, and I read your article of 13 April where you praised them, and I'm wondering if I should add to my position.
It's at 12 times earnings. You know what? There's no hurry. I like it. I talk about it over with Jeff Marks every day because we own it for the club. But I'm not going to tell you to go run out and you have to buy it right here. I mean, maybe it comes in a little and it gives you a better chance, better entry point, so to speak. Thank you. Now, when you look at what sectors are working this year, I think it's signaling that the market might be a little bit healthier than we think. On Mad Money tonight, I'm revealing another pair of winners from this volatile quarter. Fleshing out what I just said, what I just talked about. First of all, in the aerospace industry, see if stocks like GE Aerospace could take off even higher after the group's strong start to the year. And then, could Uber drive more growth ahead? I'll give you my read on the ride-sharing and robotaxi market. And later, you called in on some stocks in the industrial and mining sector. I want to take a closer look. I do not miss my deep dive on both, including one of them that I am sticking my neck out for, and I hope that doesn't happen. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.